In this video, we're going to be checking out Morgan Stanley's Chris Toomey and why he says it's a good time to be patient in this market. Today, quick recap, we got the SPY down about 1.16%, the Q's down about 1.2%. All the stocks are falling. We got big tech down anywhere from 2 to 6% today. We've got a possible Fitch downgrade coming, China worries, a lot of stuff going on. So maybe it is a good time to be patient. If you enjoy these videos, hit the like button. Let's get on into it.
Month since December, and our next guest says the most likely move for stocks from here is lower. Joining me now, post 9, is Morgan Stanley's Chris Toomey. He runs one of the highest rated private wealth advisory teams in the country. The more things change, the more they stay the same. I gave you the business a little bit last time because you're still negative in what was a pretty fierce rally. Right. We're a little rocky, a little edgy of late, as the word I've been using. And you haven't changed your view at all.
No, I mean, I think, like I said before, when the facts change, my opinion will change. I think right now we're really dealing with the fatigue of the move up higher, right? Like that was kind of a parabolic move higher, and now the market has to digest this giant move. And I think you could see that with earnings. So earnings were expected to be down. They weren't down as much, but they were still down. For companies that beat, the response wasn't as inspiring as you would typically expect, right? So you have that. You've got the seasonality of August and September typically being bad. And then you've got the technicals. When you do one of those gigantic moves higher dramatically, there's usually typically a dramatic drop before you get some sort of stabilization. So I'd say part of what we're seeing right now is just fatigue.
I mean, digestion is normal. It's a normal process, right? And for sure you wouldn't see as bigger reactions from beats because a lot of the stocks I assume you're talking about had already run a lot into the numbers.
Right, and I think that was kind of my discussion the last time I was here. The market really was priced for perfection, right? We've got expectations with regards to earnings going pretty dramatically higher, right? The market's expecting about a 10 to 15% increase over the next 12 months, and we're also expecting 5 rate cuts in 2024. So, that's a lot of good things that are expected to happen. And so there isn't a lot that could go wrong that could tip this fairly negative.
No, but when you say, you'll change your opinion when the facts change, I mean, I could suggest to you, well, the facts have changed. The facts have changed since you were first negative in that we're further down the road on rate hikes, undeniably, closer to the end. And the economy is undeniably stronger than many thought it would be to this point, including the consumer hanging in. And as you said, it's fact. And earnings have also remained better than people have feared. So aren't those strong enough facts that have changed?
So earnings are negative, right? So for the last 3 quarters, earnings have been negative. So they're down about 7% over that time period. If you look at the Magnificent Seven, which are driving the lion's share of this return, they're up over 70%, but over 63% of that is just PE expansion.
Yeah, multiple expansion.
Right? So in our minds, what's driving that? Is there a tremendous amount of growth that we're expecting? Are we expecting rates to go dramatically lower? Or the fact that the economy is actually doing better, right? And to your earlier comments with regards to no landing versus soft landing, if we get no landing, we know the Fed doesn't like that, right? Kashkari was out today saying we're not done. If the economy holds on and is continuing to go higher, we could be in a situation where the Fed is not looking at 5 rate cuts next year, but in a situation where it's not just like higher for longer, but maybe higher.
I mean,
right?
but with all due respect to Neil Kashkari, does it really matter what he says today? Or anybody else, for that matter, on the Federal Reserve Open Committee?
No.
It just matters what they do.
Exactly. But I think the reasoning with regards to what they do is the fact that they are concerned in a situation where we had tremendous fiscal stimulus this year, right? We had a situation where the market has gone dramatically higher, and we're in a situation where the labor market is very tight. We're still at about 3.5% unemployment, right? And we're in a situation where core CPI is still above 4%, right? So in that environment, the Fed is not necessarily happy seeing the economy do dramatically better.
The other point you just made in terms of, is growth really going to be as good for some of the stocks that, I mean, you mentioned the Magnificent Seven. Yeah, it actually is. aren't we learning that from some of the guidance that we're getting from the NVIDIAs of the world because of AI? I mean, that's the pushback on this idea that, you know, those stocks are way ahead of themselves.
I think the thing you need to think about is just because there's good fundamentals doesn't make it a good investment, right? At some point, price matters. And so is AI going to be a game changer with regards to the economy? Is it going to provide tremendous productivity? Absolutely. What are you paying for that right now? In my view is you're paying way too much.
Well, you're still paying less now than you were before. I mean, you don't have to comment on NVIDIA specifically, but that's sort of the perfect example of what you were paying 60 plus times a few months ago. You're paying 40 some odd times now, which for a stock like that isn't insane, or at least it hasn't been historically.
Historically, right? But that's also an environment where we had zero interest rates, right? So we're in a situation where cost of capital is now normalized. We're at over 5% in real rates. And we're in a situation where you don't necessarily need to be in a situation where you have to be in equities. And you can also discount that at a real reasonable rate and say, maybe I want to be in this when it's a little bit more attractive. So in our minds, I think there's more leaning towards the downside than the upside, and sitting in cash collecting 5 or 6% when the market in general has got a PE of 20, that's an earnings yield of about 5%. That's the same as the bond market right now.
Not everybody gets to see your every appearance and they remember everything you've said, nor for other people who have been cautious. So I just want to end with, what turns you more positive? I mean, what has to happen?
So, I mean, look, I think what you have to think about is when you look at the market, right, what's priced into the market right now? And right now you're expecting higher earnings and you're expecting lower rates. And so when the market is in a situation where it's not necessarily priced for perfection, that's when I would say this is a good opportunity to get in. So if in my view, you have maybe one of three things. Either our expectation that growth is going to be higher than what the market's pricing in, which we don't necessarily think.
6 to 9 months from now, you don't think that?
I think it's already priced into the market right now. What the market's pricing in is very aggressive growth rates. And so in my mind, unless I view that the market's underrating that growth, I don't want to necessarily add exposure. Or if the market thinks we're going to be in a situation where rates are going to go dramatically lower, then I would say, okay, now's the time to be in the market. The other thing is one of those macro situations. You get a resolution with regards to Russia-Ukraine, you get a China resolution, something that's not necessarily something that the market's pricing in right now. Otherwise, just be patient.
Well,
All right, so he is obviously very conservative. If you throw a 5% or near 5% bond yield on the table, stocks get slightly expensive, Some people's brain just doesn't see the risk reward, and they start doubting the stocks that led us here, the Magnificent Seven, like they're all of a sudden, like they're done. They just made the move, and this is the move for the rest of eternity, and they'll never grow again. And just the amount of people switching over and doubting the Magnificent Seven just because they're on a move is fascinating. It's very interesting. I've seen this time and time again. Every time they want to get a good buying opportunity in stocks, all of a sudden it's not worth anything. The growth is behind it, and yeah, it's safe, but they just can't possibly continue. And then what do you know? They smash earnings. They come out with a new product, and I'm just talking about all of the Magnificent Seven. And then they're off to new highs, and then they're saying, yeah, I bought it back when it was at this time and this number, back when I was telling you to sell it, but they don't mention that. But anyways, he is making up some good points. It is a good time to be patient. I have some cash. I'm being patient on the side, and I'm ready to get these buying opportunities. If they keep going, I'll keep getting more excited because I've got money to deploy. But hope you guys enjoyed the video. If you did, hit the like button, and I will catch you in the next one. Peace.